We're excited to present the results of our business strategy game company, Insole Inc. My name is Brie and I'm joined by Sam and Chris. Together, we'll walk you through our company's performance strategy and long-term outlook. I'll start by discussing our original approach, how we aligned our strategy, and what our financial results reveal about our success. When we began, our team chose a best cost provider strategy, aiming to offer high SQ rated footwear at a competitive price. We focus mainly on North America and Europe, where premium customers value both quality and affordability. To support this, we took a balanced approach between the internet and wholesale markets while investing early in TQM initiatives and capacity expansion. These investments helped us establish a solid foundation of efficiency, customer satisfaction, and brand reputation, all of which positioned us for a long-term growth. As market competition intensified, we made a strategic pivot in year 13 to a low-cost leadership strategy. This shift aligned every functional area of our business marketing, focused on value-based pricing to attract a broader customer base, operations implemented cost saving measures, and reduced effects through one-time production investments. Finance maintained an A-plus credit rating and strong cash reserves, ensuring financial stability. Production leveraged both North American and Asia Pacific plants for maximum efficiency. This alignment allowed for us to improve our cost position without sacrificing image rating or product quality, a balance that became one of our biggest competitive advantages. Now looking at our financial performance graph, you can see how these decisions translated into measurable results. Over the simulation, our total revenues and earnings per share consistently increased, reflecting steady growth in both internet and wholesale sales. Our return on equity improved year over year, demonstrating efficient use of shareholder funds. We also sustained an A-plus credit rating throughout, supported by strong cash management and disciplined debt control. Finally, our stock price showed steady appreciation, signaling investor confidence in our strategy and profitability. Overall, this performance highlights how Insole Inc. Successfully balanced cost leadership with brand value to deliver consistent returns across every financial indicator.
So we had multiple different production operation strategies depending on which product plant we were looking at. So to start off, we focused mostly on using the North American and Asia Pacific plants. We really didn't focus at all on the Europe and Latin American plants because of the increased startup costs that would have hurt our margins. So at the North American plant, we were able to produce about 5,000 pairs per worker, not including overtime. And the labor cost for those pairs were about $10 per pair. The total production cost for the pair came in at around $22. At the Asia Pacific plant, we had 3,600 pairs per worker on average per year, and the labor cost for those workers was about $4 per pair. The production cost was about $17. We maintained a balance with both of those plants, not only for geographical reasons, but also because the Asia Pacific plant was less efficient at producing those results. Again, like I mentioned before, in the Europe and Latin American plants, we decided to not pursue production because we found it more efficient to just ship our products from the North American plant and the Asia Pacific plant over to those markets. Our average unit cost overall fell between $15 and $25 per pair, depending on the year. And again, that was spread out across those two locations. And the result of this decision making was that we had industry-leading efficiency as we pursued our low-cost plan. So, how did this translate to geographic performance? Well, in North America, we saw a total internet market share of 19.8%, which was well above many of our competitors. The wholesale market share was around 17.3%. So compared to our 11 competitors, we had a very sizable foothold in that market and strong and steady profits. In Europe and Africa, we saw a very modest SQ rating as we pursued our low-cost strategy, but it was actually very, very profitable for us to pursue that level of SQ because we were making efficient products, not necessarily premium products. So our profit margins reflected that in the Europe and Africa region, and they came in at about 20 to 30%. In the Asia Pacific region, we saw rapid growth from a market that we really had not breached into at all at the beginning of the simulation. We increased our share in the market by about 15% over the course of the simulation, and we lowered the SQ to around 3.1 to 3.2 SQ stars, but this came with stronger margins on our end because, again, we're pursuing a low-cost initiative, and that comes with lower premium quality expectations. In the Latin America market, we found that we were profitable. This was by far our toughest market to break into. So our margins were not quite what they were in other regions. We still found that we were able to secure around a 9 to 10% market share in the market and produce that same 3 to 4 SQ star level product as we maintained our low cost plan. And in the internet marketing, for each region, our results varied, but we maintained strong margins overall, especially in the North American and Europe and Africa regions. And the same goes for wholesale. We maintained a very strong presence in wholesale marketing as we provided attractive products to resellers who were looking for low cost overall orders. So, how did this get impacted by the competitors and our environment? So, first of all, a lot of our competitors focused on producing luxury goods and raising their prices. This increased the market opening that we had, which is why we eventually pivoted to a low-cost strategy around year 13. Our pivot insulated our sales volume because we took advantage of the opening that was left by the other companies who had started out in an even place and pursued premium prices at the beginning of the simulation. This prioritized our image rating, even though we had lower premium and more efficient products. We still prioritized our image rating and maintained it above 70 for the entire simulation. We also received multiple sustainability awards over the simulation and tried to set ourselves apart from our competitors through this and celebrity endorsements. All of this was very difficult to maintain given certain market conditions. We had a few trip ups in year 15 and 16, which caused us to lose market share because of a lack of production equipment. So staying on the path of a low cost leadership company was difficult at times, but maintaining it paid off in the end. And you can see this through our steady A plus credit rating. It did dip at times during the middle of the simulation when we had to recover costs from the loss of equipment, but we were able to maintain a steady cash flow and a steady image rating and preserve our brand presence.
So looking forward to the next 2 years, our first strategic focus is going to be on branded production. We're investing in new equipment and workforce training to lift product quality and efficiency. This will directly improve our SQ rating and reduces the reject rate. At the same time, we're boosting brand strength through higher advertising and celebrity partnerships as well to grow awareness and market share. The goal is to create premium, cost-efficient branded line that sets a strong foundation for all other segments.
Okay.
So our second major initiative is to scale our private label operations. With our branded lines running efficiently, we're using the remaining plant capacity to produce high volume, lower cost private label pairs. By offering competitive bids below branded wholesale prices and optimizing materials and styling costs, we can fill unused capacity, spread fixed costs, and capture additional profit. This dual approach will keep our facilities running near full capacity while maintaining a clear distinction between our premium brand and our cost-driven private label products. So looking forward, an overview of our 2 year strategy. Our plan will integrate both strategies into one unified direction. In the first year, we strengthen our branded operations, raising quality, cutting costs, and building our image. In the second, we leverage that momentum to expand private label contracts, maximizing plant utilization and total revenue. Together, these initiatives position us for stronger earnings, a higher return on equity, and more competitive image rating industry-wide. Ultimately, the strategy gives us both short-term profitability and long-term sustainability.